Okay, we'll continue with the next problem. So take down the problem. So that is illustration number 5. So first, fifth problem. From the following particulars, prepare debtors and creditors account. From the following particulars, prepare debtors and creditors account and and find out the credit sale and credit purchase account. Credit sale and credit purchase account. So take down the problem. So copy down the question. Debtors on 1/1/2018. Debtors on 1/1/2018, rupees 5,000. Debtors on 31st December 2018, that is 31/12/2018, rupees 8,000. Creditors on 1/1/2018, rupees 4,000. Creditors on 31/12/2018, rupees 12,000. Bills payable issued during the year, rupees 8,000. Bills payable issued during the year, rupees 8,000. Cash received from customer, rupees 30,000. Cash paid to supplier, rupees 20,700. Cash paid to supplier, rupees 20,700. Cash returned to customer, rupees 270. Cash returned to customer, rupees 270. Discount allowed to customer, rupees 150. Bad debts written off, rupees 1,200. Bad debts written off, rupees 1,200. Bills receivable endorsed. Bills receivable endorsed to creditors, 4,000. Bills receivable dishonored by customer, rupees 1,000. Endorsed bill receivable dishonored, discounted bill receivable dishonored, 700. Sales return 500, purchase return 200. Sales return 500, purchase return 200. Okay, so this is the problem. First we'll discuss the problem, then we'll solve the problem. Now, they asked you to prepare the debtors and creditor account. Okay. Then they asked you to find out the credit sale and credit purchase account. Now, so credit sale is ascertained by preparing debtors account. Credit purchase is ascertained by preparing creditors account. The same logic. It's the same logic. So debtors account, if the balancing figure on the debit side, then credit sale. If the balancing figure on the credit side, then it is cash. So creditor is a liability. So reverse. So creditor is the liability. So that credit difference, if there is a difference on the credit side, means the credit balance is having the shortage, then it is credit purchase. Debit side means cash. It is just opposite to debtors account, because debtor is an asset, creditor is a liability. So it's just an opposite to the asset. So in debtors account, debit side difference treated as credit sale, credit side difference is treated as cash. In the creditors account, if you want, you take down somewhere. So right, in creditors account, so take down this point. In creditors account, if the shortage is on credit side, if the shortage is on credit side, then it is treated as credit purchase. It is treated as credit purchase. So next line you write, if the shortage is on debit side, then it is treated as cash account. So debit side it is to cash, credit side it is by credit purchase. So creditor is the person from whom you purchase the goods. ನೀವು ಈಗ ಯಾರಿಂದಾದ್ರೂ ಗೂಡ್ಸ್ ಪರ್ಚೇಸ್ ಮಾಡಿದ್ರೆ that is on credit basis, okay, not on cash basis. If you purchase the goods on credit basis, then that person will be the creditor. If you sell the goods on credit basis, then that person will be the debtor. Okay, so now, so here they clearly mention you have to prepare debtors and creditor account and find out credit sale and credit purchase. If they ask you to find out credit sale, then you have to prepare debtors account. If they ask you to find out the credit purchase, then you have to prepare creditor. It need not be that they ask everything. Okay, so directly question ಕೊಡ್ತಾರೆ ಅಂತ assume ಮಾಡಬೇಡಿ. They might just ask you to find out credit purchase and credit sale. So credit purchase means you have to prepare debtors account, sorry, creditors account. Credit sale means you have to find out, you have to open the debtor account. Okay, now first we'll pass the journal entry. Okay, you just take down the journal entry in the margin or somewhere else. Now debtor on 1/1/2018. Now debtor is the asset for me, so opening balance is always the debit balance, so it is to balance brought down, debit balance. Okay, next debtors on 31/12/2018, that is closing balance. So closing balance of asset is always a credit, so by balance carried down. Next, creditor on 1/1/2018. So creditor is my liability, so opening liability balance is always the credit balance. Trial balance rule, credit means liability or income. So creditors or any liability, their opening balance will be credit side, so it is by balance brought down. Creditors account always starts with by balance brought down and ends with the debit balance, to balance carried on. Next, bills payable issued. Now in the previous 4 problems we are dealing with bills receivable, but in this problem, as we asked you to find out the credit purchase, to prepare debtors creditors account, so bills payable. What is bills payable? If creditor issues the bill on me, ಈಗ ನನಗೆ ಕ್ರೆಡಿಟರ್ ಬಿಲ್ ಇಶ್ಯೂ ಮಾಡಿದ್ರೆ that is bills payable because I have to pay to the creditors ಗೆ ನಾವು ಪೇ ಮಾಡಬೇಕು. So I am liable to pay to the creditors. So it is a bills payable means I have to pay. If I issue the bills to debtor, then it is bills receivable because the debtor is liable to pay. You are in the position to receive the money. You are in the position to receive the money. So it is bills are receivable. Bills payable means you have to pay the bill. So bills payable is always issued by creditors. Now, so what is the journal entry? It is nothing but creditors account debit to bills payable. Creditors account debit to bills payable. So same logic, when the creditor balance, if the transaction makes the credit balance decreases, so if any transaction that decreases the credit balance means you have to record on the debit side because opposite to the opening balance. In debtors, if any value that is decreasing the debtor means you have to record on the credit side because the opening balance you return on the debit side. Opening balance in opposite side bariyudandre you are deducting the figure. Okay, now creditor you are writing on the credit side, by balance brought down means the value, if you are decreasing the value means you have to record on the debit side. So the journal entry is creditors account debit to bills payable. Next, cash received from customer. So customer means debtor. So debtor is our customer. Supplier means creditors. So supplier means the supplier of goods. So creditors. Customer means the debtor is the customer. So you are receiving the cash from the customer. So cash comes in. Debtor is the giver. So cash account debit to debtor's account. So journal entry, cash account debit to debtor's account. Next, cash paid to supplier. So supplier is a creditor. So when you pay the cash, so creditor will receive the cash. So creditor is the receiver. Cash goes out. So journal entry, creditors account debit to cash account. Cash goes out. So it's a credit. Creditor is the receiver. So debit. Cash account debit to, sorry, creditors account debit to cash account. Cash returned to customer. So customer means debtor. Returned, you are returning it back to the customer. So when you return the cash, cash goes out. Debtor will be the receiver because you are returning the cash to the debtor. So debtor is the receiver means debit. Cash goes out means credit. So journal entry, debtor's account debit to cash. Debtor's account debit to cash. Next, discount allowed to customer. So you are allowing the discount. You are allowing the discount to the customer. Customer means debtor. So you are allowing. So discount allowed is an expenses because to that extent you are not receiving the money. For example, the customer is liable to pay 10,000. So you are in the position to receive 10,000, but you will allow discount of rupees 500. Means the debtor has to pay only 9,500. So debtor is liable to pay 10,000 means you are in the position to receive 10,000. Now you are allowing the discount of 500 to the debtor means he will pay only 9,500. So 500 is a expenses for you because you are not receiving that money. So expenses means debit. So discount allowed account debit to discount allowed account debit to debtor's account because it is my expenses, so it is debited. Discount allowed account debit to debtor's account. Next one, bad debts written off. So it is the repeated transaction. Bad debts account debit to debtors. Bad debts account debit to debtors because bad debt again it is an expenses, so you have to debit. Bad debt account debit to expense debtors account. Now next, bills receivable endorsed to creditor. Now endorsed means transferred. Actually the bills receivable is issued to debtor, but you are endorsing that bill. Okay, for example, A and B are the person who are engaged, who are connected with the company. Now you are running XYZ company. A is your debtor, B is your creditor. Okay, A is your debtor, B is your creditor. Now A has to pay rupees 10,000 to XYZ company because he is a debtor, so he has to pay to the company. The company is liable of rupees 5,000 to B. So company ಈಗ B ಗೆ 5,000 ಕೊಡಬೇಕು, A company ಗೆ 10,000 ಕೊಡಬೇಕು. Okay, A has to give 10,000 to the company has to give 5,000 to the B. Now company issues the bill on debtor, so that is bills receivable. Okay, so bills has been passed to okay. Now A is the debtor, X is the company, B is the creditor. So he is the debtor. So A is the debtor, B is the creditor. XYZ is the company. Now A has to pay 10,000 to B. Sorry, X. So A has to pay 10,000. XYZ has to pay 5,000. Okay, now. So A is the debtor, B is the creditor. So A has to pay 10,000 to XYZ and XYZ has to pay 5,000 to B. So now you are issuing the bills receivable to debtor. So you can issue bills receivable. Okay, you can issue bills receivable to debtor. Okay, you can issue bills receivable to debtor, and creditor will issue bills payable. Okay, this is the logic. Because you are liable to pay, so creditor will issue. Now A is the debtor, B is the creditor, so A is liable to pay 10,000 and XYZ is a company, is liable to pay 5,000 to B. So company can issue bills receivable on debtors, whereas creditor will issue bills payable on company. Now here you just observe, see here, you issued bills receivable, correct, stating that A has to pay 5,000, stating that A has to pay, sorry, 10,000. A has to pay 10,000. Creditor, the B will issue bills payable stating that the company has to pay 5,000. Now, what is the logic? What is endorsement? You issued this bill to debtor stating that you paid 10,000 immediately, but what you tell, instead of you pay 10,000 to me, you directly pay 5,000 to creditors. Instead of A paying rupees 10,000, instead of you pay rupees 10,000 to me, ನೀನು ನಂಗೆ 10,000 ಪೇ ಮಾಡೋಕ್ಕಿಂತ It's better you pay 5,000 to creditor B. Okay, that is what endorsement. You are sending the bill. Okay, you are sending the bill. You are sending the bill to B. That is what endorsement. It means the bill is transferred from A to B. Now, when the bill receivable is transferred, it is received by the creditors. It is received by the creditors. So, the journal entry will be creditors account debit to bills receivable. Creditors account debit to bills receivable, because creditor is the receiver, bills receivable is moving out. Bills receivable is moving out. So, it is creditors account debit to bills receivable. Next, bills receivable dishonored by the customer. Again, it's a repeated point. So the journal entry will be debtors account debit to bills receivable account. Debtors account debit to bills receivable account. Next, endorsed bill receivable dishonored. Now the bill has been cancelled. So this bill has been cancelled. Endorsed bill dishonored. Now what happened? This 10,000 is added back to credit debtor. This 5,000 should be added back to creditors. And the debtor ge 10,000 add agbeku, creditor ge 5,000 add agbeku. Now what is the journal entry? Adding means you have to record on the opening side. If it is an asset, then you debit the item. If it is liability, then you credit the item. Adding back means, now debtor is an asset, so the journal entry will be debtors account debit, because debtor is an asset, it is debited. Again you are debiting means you are adding the figure. Opening balance ಯಾವ ಸೈಡ್ ಉಂಟು ಅದೇ ಸೈಡಿಗೆ ನೀವು ಎಂಟ್ರಿ ತರಬೇಕೀಗ, ಆವಾಗ ಅದು ಆಡ್ ಮಾಡುದು. So debit balance, asset is a debit, right? So you have to add the figure means you have to debit that item. So debtors account to debit to creditors account. So journal entry, debtors account to debit to creditors account, because you are adding back the figure. Debtors account to debit to creditors account. Okay, next. Discounted bill dishonored. Now discounted bill means the bill is in the hands of the banker. You can discount the bill with the banker. Okay, so now the bill is with the banker. So journal entry will be debtors account to debit to bank account. It is not bills receivable. Okay, if the bills receivable dishonored, then it is debtor to bills receivable. Now discounted bill dishonored means that bill is with the banker. So debtors account to debit to bank account. Debtors account to debit to bank account. Sales return. Sales return, again it is a repeated transaction. Sales return account debit to debtors account. Sales return account debit to debtors account. Purchase return, just opposite. Creditors account debit to purchase return, because it is related with the creditor. So creditors account debit to purchase return. Creditors account debit to purchase return. So these are the journal entry. Now we will start with the ledger accounts. Okay, next you draw the lines. First we will start with debtors account. So draw the lines. So debtors account, particulars amount in rupees, particulars amount in rupees. Particulars amount in rupees, particulars amount in rupees. Okay, now first start with opening balance. So write two balance brought down. First, with opening balance, debtor is an asset. To balance brought down 5,000. That is the opening balance. Okay, next. Closing balance will record at the end. Now you search only those transactions where you can find debtor's account. Only those transactions. Now in detail we dealt with the transactions. We have written the journal entries. Now search only those transactions where there is a debtor's account. The first one, that is cash received from customer, because you can see the debtor's account. The journal entry is cash account debit to debtor's account. So it is to debtor, means in debtor's account it is by cash. So write by cash 30,000. Okay, you just see those transactions where you can find debtor's entry. Okay, after that, the next one, cash returned to customer. There you can see debtor has been debited to cash account. So in the debtor's account, it is to cash account. So write to cash account 270. Next. So next you can find debtor in discount allowed to customer. So the entry will be discount allowed account debit to debenture, or you can write discount account. So it is by discount account. You can write by discount allowed or by discount account. By discount account or discount allowed account. Next, bad debts written off. So journal entry, bad debts account debit to debtors. So it is by bad debts account. So by bad debts account 1,200. Next, after bad debts, the next entry will be bill receivable dishonored by the customer. So the entry you have passed, that is debtors account debit to bills receivable. In debtors account, it is to bills receivable account. That is 1,000. To bills receivable account 1,000. Next, after that, endorsed bill receivable dishonored. Endorsed bill receivable dishonored. The entry is debtors account debit to creditors. So right, to creditors account 500. Next one. After this, next transaction. Discounted bill receivable dishonored. So debtors account debit to bank. So in debtors account, it is to bank 700. Debtors account, it is to bank 700. Next, sales return. Sales return. So sales return account debit to debtors account. So it is by sales return 500. By sales return 500. After that, purchase return, it is not connected with debtors. And the last one, that is closing balance, that is debtor balance, it is credit side. By balance carried down 8,000. Okay, next you find out the total. Again, the credit side is 4. So first you calculate the total of the credit side, then you write it on the both the side, debit as well as credit. Now the total is 39,850. 39,850. Now you calculate what is the credit sale value. So calculate the credit sale value. So your credit sale value is 32,380. 32,380. So this is the debtor account. So you calculated what is the credit sale value. Okay, next draw the lines for creditors account. Creditors account. So draw the lines for creditors account. Okay, now start with the opening balance. So creditor is a liability. So opening balance is always the credit balance. So write by balance brought down 4,000. By balance brought down 4,000. By balance brought down 4,000. Okay, next you see the transaction where you can find the creditor value. The bills payable issued. You see the fifth one, payable issued. So journal entry, creditors account debit, 2 bills payable. So it is 2 bills payable account. 2 bills payable account 8,000. Next, after that, cash paid to supplier. So what is the journal entry? Creditors account debit to cash. Again, it is to cash account. To cash account. To cash account 20,700. Next, bills receivable endorsed to creditors. So the journal entries, creditors account debit 2 bills receivable. So in creditors account it is 2 bills receivable. Next, endorsed bill receivable dishonored. Endorsed bill receivable dishonored. So the journal entry is debtors account debit to creditors. So you can see here it is to creditors account, right? You can see the creditors account. So to creditor means this should be by, correct? So the next entry, that is by debtors account. So here it is to creditors, here it is by debtors. To creditors in the debtors account, by debtors in the creditors account. So by debtors account 500. Next one, that is purchase return. Creditors account debit to purchase return. So it is to purchase return account 200. Okay. So after this, the closing balance. So the opening balance of the liability is debit. The closing balance will be, sorry, opening balance of the liability will be credit, or closing balance will be debit. So it is to balance carried down 12,000. To balance carried down 12,000. Okay, now you find out the total. Your debit side is more. Your debit side is more. So first you calculate the total. So submit the debit balance 8,000, 20,700 plus 4,000 plus 200 plus 12,000. So it comes to 44,900. The balancing figure will be the credit purchase. So calculate what is credit purchase value. So write by credit purchase account. So by credit purchase account, that is balancing figure 40,400. 40,400. So this is your debtors and creditors account. So remaining we'll see in the next class. Okay, thank you.